Once again, it's about time for investors to decide for themselves whether stocks are massively overvalued and overbought, or perhaps cheap. So today, we will look at the bad news. In the next video, we'll look at better news. If you make it through this video, just remember what Stevie Guitar Miller said: you've got to go through hell before you get to heaven. So, let's take a look. This chart is from Bank of America and is a breakdown of the S&P 500 across a wide variety of valuation measures. There are 20 in total. What the analysis shows is that of these 20 different metrics, the S&P 500 is overvalued based on 17 by as much as 92% on a historical market cap to GDP basis. If you look at the S&P 500 in WTI terms, or oil, the S&P 500 is overvalued by up to 122%. Now, only 3 of the measures show the S&P 500 is cheap. But let's go through the list item by item. First, there may be some acronyms that you might not be familiar with. We are not going to delve into these too much because it's the overall message that the S&P 500 may be overvalued by these measures. If you're interested in finding out more about the individual measures, it's relatively easy enough to search for the information. But again, it's the overall message that's important here. But as you can see, the first block of measures, which are contained within the red outlined box, are all showing overvaluations. And this list includes, from the top, the trailing PE, the trailing gap PE, the forward consensus PE, the trailing normalized PE, the median forward PE, the Shiller PE, the price per book value, and the enterprise value to EBITDA. Skipping down a few measures, we see that the price to operating cash flow, or price/OCF, also shows overvaluation. Skipping down again, we find another block of overvaluation indications, beginning with enterprise value to sales, the equity risk premium, the normalized equity risk premium, and then a selection of measures compared with the S&P 500, including oil, gold, the Russell 2000, the Russell 2000 forward PE, and the S&P 500 market cap to GDP. Again, only 3 of these measures show the S&P 500 may be cheap, and this includes the trailing and forward peg and the price to cash flow, and they are contained within the green boxes. Now, while you let all of this sink in, it gets worse, literally and figuratively. So let's take a look at that. And this chart here is from Morgan Stanley and shows some key global and U.S. economic indicators that imply the market is worse now than it was in 2007, just before the great financial crisis. Now, don't get angry with me. Once in a while, it's a good idea to keep in mind what others are thinking. And right now, there's a lot of negativity out there. So looking at this chart, by every measure, today is considered worse than 2007. Globally, in the United States, in Europe, and even in Asia, it's all considered worse by these measures. But keep in mind that Morgan Stanley, who did this chart, is kind of a negative Nelly. So I'm not too surprised that they came up with this chart. So read through this and you can put the video on pause and get a better idea of all of these different categories and items. But I do have much more that shows how bad things are. But let me save you all the details. All you have to do is read the newspaper on any given day to know that there's a lot of chickens out there waiting for the sky to fall. But in the next video, we'll look at some more favorable information. Until then, don't be looking up at the sky too much waiting for it to fall. And for today, that's ChewDog Charts. Thank you.